Liquidity is shifting, policy risk is rising, and the leadership in this market is getting dangerously narrow. Today, we're going to talk about why the dollar matters more than you think so, why recent Treasury auctions sent a warning out, and how a mix of tariffs, slowing jobs, and rate cut expectations could force a big change in the market's overall direction. For a quick recap on markets today, the NASDAQ managed to a late day rally to close at a fresh record high for the first time in over just a week. Time flies by, right? It was up almost 0.4% after briefly trading lower earlier in this session. A tough trading day. This drop wiped out an earlier rally before the buying came back in at the end of the day. The S&P 500 slipped 0.1% on the day. The Dow Jones Industrial Average about 0.5% down. And what this intraday pattern tells us is that momentum is still there, mainly in tech stocks, but overall market participation is weak, hinting at questions along market breadth. Now, let's look at some of the concerns right now, because some strategists believe the market is looking past the expectation of slower growth in the second half of this year and already betting on some of the things to look forward to on this rebound next year that supposedly happened. And that rebound would be fueled on lower interest rates from the Federal Reserve and stimulus from President Donald Trump's what he calls the one big beautiful bill. But right now, I mean, there's this bull narrative because there's over $7 trillion sitting in money market funds earning roughly 4.5% right now. And what everybody's bringing keen attention to is that if short rates tend to move down to say around 4.25% or even 4%, some of that cash could come back into the stock market. And what that is seen as a bullish argument that there's money on the sidelines just waiting for an opportunity to make a move with. And these short-term rates could be the catalyst to look out for. But on the flip side, liquidity could be constrained if credit quality begins to weaken and lenders start demanding bigger premiums to loan to lower quality borrowers. So that's something to watch out for. But Torsten Slok, who is a chief economist at Apollo Global, says that there's a few main risks that are being ignored right now by markets. Three main, but I guess in a way there are two. So the first would be stagflation, that a mix of slow growth and stubborn inflation. And the second is how concentrated the market is in just a handful of giant technology companies. He points out that foreign investors make up about 30% of the demand for U.S. Treasury bonds after weakening earlier this year in terms of the US dollar. It has recently steadied, but if the dollar were to fall sharply from here, which he doesn't expect to happen, at least in his base case, it could add to inflationary pressures, and especially when combined with tariffs, which are also seen as inflationary forces. But what Slok warns is that you cannot have a healthy economy driven by just 7 mega tech stocks, shouting out the Magnificent Seven. Nvidia alone makes up around 8% of the S&P 500 index, and that's the largest single stock weight since dating back to 1981. And if the other 493 companies start to see earnings slow and costs rise, they could cut their spending on artificial intelligence projects, and that would hurt the big 7 companies that have been leading the market higher. Pretty much a big old mess is what we're trying to sum up right now. And then earnings. Let's talk about earnings, because earnings are strong, but the tone is cautious right now. So far the earnings season, at least for companies in the S&P 500, have beaten earnings expectations by about 8% on average. That's great. Sales have been stronger than expected. Awesome. And profit margins are improving. So all of that's good news. Most sectors are beating expectations and more companies are raising guidance than cutting it, but there's a different tone in the conference calls, and a lot of executives are expressing uncertainty, especially about tariffs. For example, we had Amazon come out, and what they said is that it is unclear who will absorb the higher cost if tariffs continue going up. And it seems like there's a trend here that tariffs and this tariff war isn't over with. I mean, the tariffs just kicked in today and Trump's already threatening higher rates for some countries. So if inflation still hasn't dropped to the Federal Reserve's 2% goal, and there's no guidance that interest rate cuts are coming soon, if consumers and business spending slows, those optimistic forecasts that strategists and economists see for these companies could prove too high and valuations come into concern. Now, on the policy front, President Donald Trump signed an order for the Labor Department and the SEC, the Security Exchange Commission, to review rules that would make it easier for people to hold cryptocurrency and other alternative assets in their 401k retirement accounts. This is pretty big. The Federal Housing Finance Agency is also studying whether to allow crypto assets to count towards borrowers' assets when applying for a mortgage without requiring them to convert it to cash first. Some lawmakers are warning that this could add risk to the housing market, given how volatile cryptocurrencies can be. But others see this as super huge and a big foundation for crypto in the longer term finance space here in the United States, because if they don't have to sell their assets and their crypto assets, and they could claim them as assets when applying for loans, for one, you don't have to sell, so you're not entitled to capital gains, hopefully capital gains, not capital losses, right? But also, I mean, stocks are pretty volatile and they're able to consider in stocks, so I see the direction they're trying to take here. But more news, and I'd say this is a huge piece of news that we got. Trump also tapped Stephen Myron, I hope I'm saying his name right, who is his top economic advisor to serve as the Federal Reserve governor until the end of January. So it's temporary, but Myron is a strong supporter of tariffs and has argued that they have not caused inflation, which, depending on who you ask and what you're looking at, that can be questionable. But his temporary seat will still require Senate confirmation, so it's not quite a done deal yet. Meanwhile, the U.S. has imposed steep new tariffs at midnight, so today they officially kicked in on imports of dozens of countries. Major economies like the European Union, Japan, South Korea, all of them face around 15%. Southeast Asian countries or nations such as Indonesia and the Philippines face a 19% tariff. Vietnam faces 20%. And what we're seeing is that trading partners are rushing in, lobbying for exemptions because now they can't handle it. So maybe this is where the deals start getting made, but at the same time, Trump is still pressuring people, saying, hey, we could still raise your tariff rate. So there's still a lot of going back and forth and negotiating going on in the background. Now, we had a Treasury auction today, and the Treasury Department sold $25 billion of 30-year bonds at higher yields than expected, which this isn't a good sign. This is a sign of weak demand. Yields rose as prices fell, and foreign buyers took a smaller share than usual, and primary dealers, which are these big banks, are required to buy the unsold bonds. Took their largest share, so these big banks took their largest share since last August. And weak demand for both the 10-year Treasury and the 30-year Treasury auctions suggests that investors want higher yields before committing to buy U.S. debt. And that matters because of a few different things, but mainly it's because it raises borrowing costs for the government, businesses, and households. So everybody suffers from this. Now, back on credit cards, the Federal Reserve reported that the revolving credit, mainly credit card balances, fell for the second straight month in June. And that is rare outside of recessions or crises. Now, non-revolving credit such as auto loans, student loans, both of those rose slightly, but overall consumer credit increased by $7.4 billion. And what economists think is that consumer spending will keep slowing as incomes grow only modestly, not keeping up. And imported goods become more expensive due to these tariffs that we keep talking about. Now, Raphael Bostic gave us some of his opinion as to what he's seeing. So he's the Atlanta Fed president. So Raphael Bostic says he still sees one interest rate cut this year, despite many traders betting on more aggressive easing. The July jobs report showed just 73,000 jobs added, with a large downward revisions to prior months. Other Fed officials are sounding more open to rate cuts if the labor market continues to see softening, which Maybe it does, maybe it doesn't. But there are no clear consensuses yet. But Bostic also said that the biggest question right now is whether tariffs are still just a one-time shock or if they will have persistent effects that could cause more structural changes in the economy. Businesses are still hesitant to invest or even hire until they get clarity, so it's still a wait and see all around. And finally, the Kremlin says President Putin and President Trump have agreed in principle to meet possibly next week as a White House deadline approaches for Russia to make progress towards ending that war with Ukraine. That meeting could create volatility in energy markets, currencies, and defensive stocks, depending on what the outcome is, but everybody's going to be watching how it impacts oil and inflationary concerns regarding oil. So, the market is climbing on a very, very narrow group of leaders, while bond demand weakens, consumers pulling back, and trade tensions intensifying. Now, whether or not this turns into a rotation or a correction or just another melt-up will depend heavily on what happens with the dollar, Treasury demand, and how far these tariffs ultimately go. I'll keep tracking for you each way, every step. I'll try to keep on doing it every day. I'm about to go to church, so I'm glad I popped this video out. I didn't think I'd have enough time, but I had to do it for the comments in the last video I posted. So be back tomorrow. Come and join me. We're learning together, and I'll see you.